So NIO just dropped its Q3 earnings. And honestly, it's a real head-scratcher. It's a report that tells two completely different stories at the same time. On one side, you've got some seriously impressive financial discipline. But on the other, a sales slowdown that's got people worried. So which story is the real one? Let's dig in and figure it out. Here's the billion-dollar question, right? The one on every investor's and EV lover's mind. After all these years of spending big and growing like crazy, is NIO finally, actually, on a clear path to becoming a profitable company? That's the core puzzle we're going to unpack today. And you can see why it's confusing right away. The numbers almost feel like they're fighting each other. I mean, NIO beat its earnings per share estimates. That's a definite win. But then it missed on revenue. And maybe even more concerning, they lowered their sales forecast for the super important holiday quarter. So wait, how can both of those things be true? Okay, so to really get what's going on here, we have to look past the flashy headline sales numbers. We need to focus on the company's aggressive, and I mean aggressive, push to finally make money. It's actually in the less obvious details where we find the really good news. You know, it's easy to get fixated on just the sales figures, but the real story, the big headline this quarter, was something else entirely. While everyone was watching the sales, NIO was quietly getting its financial house in order. They've been tightening the belt, focusing on efficiency, and wow, the results are really starting to show. Check this out. A vehicle gross margin of 14.7%. Now, for an EV company that's still in its growth phase, that number is huge, and it totally blew past expectations. It tells us that for every single car they sell, they're making a much, much healthier profit. And hey, if you're not a numbers person, no worries. Gross margin is actually pretty simple. It's basically the raw profit a company makes on the stuff it sells. Think of it like this. It's the money left over from selling a car after you pay for all the parts and the factory labor. A higher number here? That's a fantastic sign of a healthy business. And look, this wasn't just a lucky quarter. You can see a clear trend here, a steady climb in their vehicle margin over the past 3 quarters. The company says this is thanks to comprehensive cost reduction efforts with their suppliers. Long story short, they're just getting way more efficient at building their cars. And it goes way beyond just the margins. Take a look at this. Their operating loss shrank by 1/3. They cut R&D spending by a lot, but they claim it's not going to hurt future products. And this is the big one. Their cash flow actually turned positive. They brought in more cash than they spent. That is a massive, massive milestone. So you might be asking, okay, how are they doing all this? Well, a big part of it comes down to their strategy, which is getting a lot more sophisticated. Now it's all about 3 separate brands. See, they're not trying to be everything to everyone with one car anymore. They're getting smart about it. You've got the main NIO brand. That's your premium high-tech player. Then you have ONVO, which is their big move into the mainstream family market. And finally, there's FIREFLY, for people who want a stylish, high-end small EV. It's a classic move to capture different buyers at different prices in a super competitive market. But what connects all 3 of these brands? What's the secret sauce? Well, it's this one-of-a-kind technological advantage that really no other major car company has at this kind of scale, and that's their massive network for battery swapping. Yeah, over 3,600 of these power swap stations. This is a game changer. It means drivers of a NIO, an ONVO, and soon a FIREFLY can just pull in and in a few minutes swap out a dead battery for a fully charged one. It's a huge selling point that props up the value of all their brands. Okay, so we've got better financial discipline, a clear strategy. It's all looking pretty good, right? But that brings us to the other side of the coin, the bad news from the report. That lowered sales forecast. Let's take a closer look at what's going on there. And this is where things get a little tricky. It's the big paradox from the earnings call. If the company is getting so much healthier and more efficient, why on earth do they expect to sell fewer cars next quarter than they thought they would? Well, according to the CEO, William Lee, it all boils down to one thing: government subsidies. There's this big trade-in and replacement subsidy program that got phased out in the middle of October. So what happened? Everybody rushed to buy a car before the deadline, and then, poof, a sudden slowdown right after. This hit their more affordable ONVO brand especially hard. And now the company says the whole industry probably won't see that big year-end sales rush we're used to. But here's the thing. Even with this slowdown affecting the whole market, the leadership is not backing down. The CEO came right out and said it on the call, basically saying that even if they sell fewer cars, their better cost controls and higher margins mean they can still hit their goal of breaking even in the fourth quarter. And all of this really sets the stage for the final and maybe the most important part of this story. What's next? They're looking past these current challenges toward a very, very specific goal. Look, management is basically saying, yeah, the current market is a bit soft, but that's just a short-term blip. They use the earnings call to lay out a very clear step-by-step plan to get the entire company profitable for a full year by 2026. So let's break down this roadmap. What does it actually look like? Step 1 is hitting that break-even point this quarter. The next huge milestone is to start delivering 50,000 cars a month in the first half of next year. And if they can pull that off, they believe they can finally reach the Holy Grail, profitability for the entire year of 2026. And to make all that happen, it's not just about selling more cars. It's about selling them more profitably. That's the key. The big target is to get their vehicle gross margin up to around 20%. A number like that would give them the financial muscle they need to be profitable for a full year. So at the end of the day, where does this leave NIO? They're coming out of this quarter with a great story about disciplined execution and a clear plan. But it's all happening under the shadow of a really volatile market. They've got the strategy, they've got the tech, they've got the financial targets. The ultimate question, though, is can they actually navigate all the intense competition and policy changes to make this ambitious plan a reality?